Most Canadian investors focus on maximizing investment returns, beating the market, finding undervalued stocks, timing their entries and exits. These are all important, but they're missing something equally critical, and often far more controllable. Here's what we'll cover: the 3 types of investment income, capital gains, the 50% advantage, and the dividend tax credit. Stick around, the strategies in here add up to real money. The 3 types of investment income. All investment income falls into one of 3 categories: interest income, dividends, and capital gains. A capital gain is the profit you make when you sell an investment for more than you paid for it. In Canada, only 50% of capital gains are taxable, the other 50% is tax-free. This inclusion rate was set to increase to 66.67% under the cancelled federal budget proposal, but that increase did not proceed. This means capital gains receive more favorable tax treatment than interest, but less favorable than eligible Canadian dividends. Note, calculations based on 2026 Ontario marginal tax rate of 29.65% on income over $80,000. Actual rates vary by province and income level. These are simplified examples. Actual dividend credit calculations vary by province. Capital gains have one of the simplest and most elegant tax advantages in the Canadian tax code: only 50% of gains are taxable. Here's the mechanics. When you sell an investment at a profit, you bought 100 shares of ABC Corp at $50 per share, $5,000 total. You sell them at $70 per share, $7,000 total. Capital gain: $7,000 to $5,000 equals $2,000 taxable amount. $2,000 times 50% equals $1,000 tax owed. At 29.65% rate, $1,000 times 29.65% equals $296.50 after tax gain. $2,000 to $296.50 equals $1,703.50. You keep 85% of your gain. The tax takes 15%. Compare this to interest income, where you'd lose 30% of the gain to taxes. In June 2024, the federal government proposed increasing the capital gains inclusion rate from 50% to 66.67%, meaning 2/3 of gains would be taxable instead of 1/2. This would have significantly increased the cost of realizing gains and encouraged hoarding positions. After substantial criticism from investors, business owners, and investment professionals, the government cancelled this proposal in March 2025. For Canadian investors, this was a major win, and it means your long-term capital gains will continue to receive their current tax advantage. One powerful feature: capital losses can be used to offset capital gains. If you realize a $5,000 gain on one stock and a $2,000 loss on another, you only pay tax on $3,000 of gains, the net amount. We'll explore this more in the tax loss harvesting section below. Here are the key insights to take away. You calculate your gain, sale price minus adjusted cost base, ACB. You include 50% of that gain in your taxable income. You pay tax on that 50% amount at your marginal tax rate. The dividend tax credit is one of the most powerful, and most misunderstood, features of the Canadian tax system. Eligible Canadian dividends are from established Canadian corporations that have already paid corporate tax. Non-eligible dividends are typically from small corporations or Canadian-controlled private corporations, CCPCs, that paid a lower rate of corporate tax. For individual investors, eligible dividends are the ones that get the big tax break. Non-eligible dividends are grossed up by only 15% and receive a smaller credit, making them tax more heavily, though still better than interest. Asterisk effective rates shown are approximate for Ontario at $80,000 plus income and vary significantly by province and income level. Here's how it actually plays out. Gross up: dividend income is grossed up by a fixed percentage, 38% for eligible dividends, 15% for non-eligible dividends. Income inclusion: you include the grossed up amount in your taxable income. Credit: you claim a federal dividend tax credit, which offsets a portion of the tax you owe on that income. Net result: after the credit, your effective tax rate on dividends is much lower than on equivalent interest income. Asset location. They focus on which investments to buy but not on where to hold them. Non-registered accounts don't shelter growth, but they do let you claim capital losses, which RRSPs and TFSAs don't. This flexibility is incredibly valuable. RRSP, bonds, GICs, fixed income, and U.S. dividend stocks. TFSA, growth stocks, REITs, and volatile equity positions. Non-registered, Canadian dividend stocks and tax loss harvesting positions. If you follow this structure, you'll automatically be getting most of the tax benefits available to Canadian investors, without having to think about it for every individual trade. Here's how it actually plays out. Interest income is fully taxable, so sheltering it saves 30% or more in taxes. Within an RRSP, you get tax-deferred growth, compounding works at full power. Foreign stocks in your RRSP avoid the 15% U.S. withholding tax on dividends. Thanks to the Canada-U.S. tax treaty, this saves a huge amount over time. Tax loss harvesting sounds complex, but it's a straightforward strategy. Sell investments that have declined in value to realize a capital loss, then use that loss to offset capital gains, or up to $3,000 of regular income in a year, with unlimited carryforward. In any given year, you'll likely have some positions that are underwater, trading below your purchase price. Instead of holding them forever, you can. Scenario: earlier in 2026, you realized a $15,000 capital gain on the sale of Tech Stock A. By November, Growth Fund B has declined by $8,000. Without harvesting, you owe tax on the full $15,000 gain. At 50% inclusion and 29.65% rate, $2,222.50 in tax. With harvesting, you sell Growth Fund B and realize the $8,000 loss. Your net capital gain for the year, $15,000 to $8,000 equals $7,000. Tax owed, $1,037.50. Tax saved, $1,185. Tax loss harvesting is most effective. Canada's tax authorities don't want you gaming the system by selling a loss and immediately buying it back. That's where the superficial loss rule comes in. More on this below, but briefly, don't buy back the same or substantially identical investment within 30 days of selling it. Here are the key insights to take away. Sell the underwater position and realize the loss. Claim the capital loss on your tax return. Use it to offset capital gains from other sales that year, or from previous years, back 3 years. If you have unused losses, carry them forward indefinitely. The superficial loss rule, and how to avoid it. You cannot claim a capital loss on the sale of an investment if you, or your spouse, or a controlled corporation, buy the same or substantially identical investment within 30 days before the sale or 30 days after the sale. The 30-day window is 61 days total, 30 days before, the day of sale, and 30 days after. If you breach this rule, the loss is denied and added to the cost base of the replacement investment instead. The CRA interprets this strictly. The CRA takes this rule seriously. If you harvest a loss and accidentally buy back a substantially identical investment within 30 days, the loss will be denied, but you won't find out until years later during an audit. The tax bill, plus interest and potential penalties, can be painful. Track your buy-sell dates carefully. Use a simple spreadsheet if you're doing tax loss harvesting. Better yet, consult a tax professional if you're harvesting significant losses. There are several ways to harvest losses without running afoul of the superficial loss rule. Sell a Canadian dividend ETF and buy a U.S. dividend ETF or growth stock. Sell a bond ETF and buy a GIC or bond mutual fund with different holdings. The asset class or geography is different, so the rule doesn't apply. The simplest approach: sell the position, wait 31 days, then buy back the original investment if you still want it. Your portfolio is out of that asset class for a month, but the loss is locked in and the superficial loss rule doesn't apply. Here are the key insights to take away. Same stock, same investment, obviously identical. You can't sell and buy back the same shares. Very similar ETFs, two Canadian dividend ETFs tracking nearly the same companies? Probably substantially identical. Different asset class or geography, selling a Canadian bank stock and buying a US bank ETF? Likely not identical. ETF versus mutual fund with same holdings, might be considered identical. Lifetime capital gains exemption. If you're an entrepreneur, this is one of the most valuable tax breaks in Canada. You can claim the LCGE when you dispose of. As a passive investor buying public stocks or ETFs, you will not qualify for the LCGE. It's primarily for business owners and entrepreneurs. The lifetime exemption limit is indexed annually for inflation. For 2026, it sits at $1,275,000. This means you can realize up to $1,275,000 in gains on qualifying property completely tax-free over your lifetime. If you're selling a business or a significant stake in a private corporation, this exemption can save you hundreds of thousands of dollars in taxes. But claiming it requires careful planning and documentation. Work with a tax professional if this applies to you. Here are the key insights to take away. Qualifying small business corporation, QSBC, shares of a private corporation where you own at least 10% and the corporation meets specific criteria, mostly using its assets in active business in Canada. Eligible capital property, in some cases, this is complex, consult a tax lawyer. Farming or fishing property, special rules for family farms and fishing operations. U.S. dividend withholding tax. Many Canadian investors hold U.S. stocks or U.S.-listed ETFs. This is a major reason to hold U.S. dividend stocks and U.S.-heavy ETFs in your RRSP, not your TFSA or non-registered account. Over a long holding period, the 15% withholding tax adds up significantly. Asterisk in a non-registered account, you may be able to claim a foreign tax credit for the 15% withholding, but this requires tracking and reporting on your tax return. Many taxpayers don't bother. RRSP, U.S. dividend stocks, benefit from 0% withholding, TFSA, U.S. growth stocks, capital gains don't face withholding, non-registered, Canadian dividend stocks, benefit from dividend tax credit. Putting it all together, a complete tax-efficient portfolio. Assume you have $100,000 to invest across 3 accounts with the following recommended allocation. Here's what happens with this structure. Across this entire structure, you've captured the major tax breaks available to Canadian investors. Here are the key insights to take away. Bond interest, fully sheltered from tax. Grows tax deferred at full power. Over 20 years at 4%, that's $76,000 instead of $56,000. Tax savings, $6,000. U.S. dividend stocks, dividends arrive without 15% withholding, thanks to the treaty. If you held this in a TFSA instead, 15% of dividends would be lost forever. Final takeaways. Tax-efficient investing isn't complicated, but it requires intentional thinking about 3 dimensions. Here's the order: what you invest in, stocks, bonds, REITs, ETFs, etc., what type of income it generates, interest, dividends, or capital gains, where you hold it, RRSP, TFSA, or non-registered account. Get all 3 right, and you can significantly reduce your tax bill without taking excess risk or breaking any rules. The strategies in this guide: understanding investment income tax treatment, using asset location strategically, capturing the dividend tax credit, harvesting tax losses, and respecting the superficial loss rule, are available to every Canadian investor. They don't require a financial advisor, special accounts, or proprietary tools. They're just good planning. The difference between the 2 investors in our opening example wasn't luck or skill in picking stocks. It was understanding that $906 in taxes, 9% of returns, beats $2,965, 30% of returns, and then structuring their portfolio to capture those benefits consistently over time. Ready to go deeper? This guide covers the essentials of tax-efficient investing. But there's much more: advanced strategies for small business owners, tax loss harvesting with margin accounts, integrating real estate into your tax plan, and more. You've got the playbook. Keep optimizing.